Welcome to the basics. I'm so excited for this episode. Honestly, when we started the basics, we never thought we will learn so much, and there will be so great teachers who will be welcoming to teach us. We have done some good work in terms of learning about sectors and learning about how to invest in the micro caps in the Indian markets. It's my privilege, to welcome Ian and learn from him that how to invest in the micro caps in the US markets. Ian, dil se dhanyawad and namaste from India to you and your family.
Thank you. No, it's an honor to be here, and I've just been overwhelmed by some of the feedback and support I've gotten from India, and that kind of goes back to when Professor Bakshi kind of first reached out to me and kind of spread some word about me over there, and so I'm honored to be here with you. I'm really
But to be honest, a lot of Indians are waiting to hear you. You are if I may say, a rock star in terms of investment names, and a lot of people follow you in India.
Yeah, I think I'm probably more well known in India than I am over here in the United States. So, like I said, I'm honored for that. Yeah.
So, Ian, before we start anything, tell me who Ian is. Like, who are you? Your journey, investment journey, your family, whatever you want to tell us.
Sure. Yeah. So I just turned 40 a couple of weeks ago, so I'm officially middle aged. I have a wife.
Birthday.
Yeah, I have a wife of 10 years and 2 kids. I have a daughter that's 5 and a little boy that's about to turn 3. And, my journey started in investing when I was maybe 16 years old, when I was in high school.
Wow.
Yeah, it was a long time ago. And, I was lucky enough that I had, my parents saved for my college education. And they told me back then, we've saved for you this amount of money. This is all you're going to get. So it's up to you to decide where you want to go. If you want to go to a really expensive school, then you got to go into debt and pay for the rest yourself, or you can decide what you really want to do. And so that's really how I got introduced to the stock market, because I took that amount of capital they gave me and opened up an account with their financial advisor, and he introduced me kind of the markets. And this was 1997, 98, so dot-com bubble area of the market. And so it was easy to get attracted to the market.
So you earned a lot of money at that point of time, right?
Yeah, I mean, you could have threw a dart at the newspaper of stocks and it made money. So it wasn't hard to do. I turned that about 20,000 USD into about 120,000 in a few years at the peak of the bubble. Thinking I was really smart when really it was luck. And when I decided to go to kind of a lower priced university so I could continue to invest that and not spend that on my education. And I also worked for a financial advisor during university as well. And I ended up riding that bubble the whole way back down. So that 120,000 USD turned into about 8, at the bottom of that cycle. So
let me gather this, okay? So from 20,000 USD, it went to 120,000 USD. And back then it came down to some 18, right? 1-8.
No, 8. There's no 1 in front, just 8. Yeah, unfortunately, it was just an 8. So, I learned a lot through that experience. I mean, I basically just rode those small cap technology names the whole way down, kind of continued to average down in them. And at the same time, I was working for a financial advisor. And so I was kind of just answering the phones for his clients that were calling, and they were, calling up in every emotional state you can imagine. And that also was sort of the push for me, because up to that point, I thought I was going to be a financial advisor. I told myself, I really don't want to deal with other people's emotions. Investing's hard enough just dealing with your own emotions. And that's sort of the time period that, the fire got lit in me, that I just wanted to be a full-time private investor, just trying to manage my own capital. And I just needed to figure that out. And it was also around the same time, this is kind of funny too, those small cap tech names, a lot of them turned into microcaps. So that's kind of how I got introduced into the microcap landscape, is because unfortunately some of the larger companies turned into them when that bubble crashed. So really from that point forward, I researched my first microcap, which was a company called XM Satellite Radio. It was a satellite radio service provider. Back in 2001, that was a new emerging field. That was basically like venture capital. Everybody still had terrestrial radio. And, I was just drawn to the story, to be honest with you. It wasn't really anything to do with the fundamentals of that company, but I just bought into that vision of just having clear satellite radio wherever you drove your car. Back then, that stock was a microcap. It was 40% held short. So there was a lot of people betting against that company because they spent probably $1 billion USD launching satellites up into space and didn't have many customers at that point in time. But I loved it. I ended up reaching out to a conference where the CEO was going to be presenting up in New York City. To give you an idea, I'm from Lancaster, Pennsylvania. It's about a 3-hour bus ride to New York City. I was still in college. I called up the conference organizer, said I'd really like to participate in this event. You know, my name's J.Cassel with Castle Capital, which I made up. And they let me come to this event. And so I took a bus up there. Long story short, you know, I ended up following the CEO of XM into a one-on-one room. We had a conversation. It lasted about 10 or 15 minutes before his first institutional meeting occurred. And, you know, my eyes were as wide as saucers, and just the ability to actually talk to a management team was, you know, just beyond imaginable to me. And so I ended up taking that bus ride home, took that $8,000 I had left and bought XM Satellite Radio at $1.78 per share. I can still remember that trade like it was yesterday. And, you know, really, honestly, from that point forward, literally the next week, they started signing up OEM agreements with Ford, GM, and other auto manufacturers. They ended up refinancing their debt, and it just lit a short covering rally in that stock that propelled that stock from about $1.78 per share to about $34 per share in about 14 months.
Wow.
So just a historic, you know, just a meteoric rise. And I ended up, I forget, selling maybe around $20 or something like that. And, you know, obviously I look back on that experience and that was 150% luck, you know, and I understood that. But it's really the story that I like to tell because it's a true story, and it's the one that got me infatuated with microcaps and the ability to sit down with management teams, and that's what got the fire lit in me to be a microcap investor.
You know, you made a very important point here, you know, which is the difference between skill versus luck. You know, the way the markets are going now, whether it's India, whether it's US, and everyone is loving the way people are making money. There's a lot of difference between, you know, skill versus luck, right? You want to share more thoughts on that because you were lucky to make that 20,000 to 120,000. It was not a skill, right?
Right. Yeah. I mean, you have to be. I think it's really important to be self-aware of what a win was. And listen, we're all lucky. I mean, you've been investing a long time, and you can still point to areas that you've been lucky, you know. And I think there's a piece of luck with every winner that we have, because investing is hard, running a business is hard. Whether it's investing or business, you know, it's really a combination of opportunity, execution, and luck, if we're all being honest with ourselves. And so luck does play a role, but, you know, I think there's certainly some instances in all of our past as investors that we can point to that it was probably 95% luck. And I don't think my story is too different. You know, yeah, maybe the details are different, but I think a lot of people, you know, got lucky maybe their first go around or two, you know, in the market.
Yeah.
And we're certainly seeing that in today's market, at least over here in the United States. Sort of like the small cap and even microcap arena have really been on fire in the last 45 days. I mean, just to give your listener an idea, you know, the IWC, which is the Russell Microcap Index in the United States, is up 27% year to date. And, you know, so it's February 9th today, up 27% year to date. The smaller area, the LD Micro Index that tracks that, it's up 42% year to date.
Wow.
You know, beginning of January. And
so everyone is loving you.
Yeah, everybody wants to be a microcap investor now. So yeah.
I also heard about a story when your wife actually doubted you as a drug dealer, right?
Yes. Yeah. Yeah. Well, when we first started dating, I rented if you can just picture a red barn, like you're on a farm. And it was a big red barn that looked like a big red barn, like you'd have tractors and cows and pigs in there or whatever, but it just happened to be an apartment. You know, it was a 2-bedroom apartment inside. It was not a barn inside, but it looked like one on the outside. And, you know, when we first started dating, she would ask me what I did. I'm like, well, I invest in the markets. And right when we started dating, I had a couple big wins. And quite honestly, I didn't really have the maturity at that time to kind of deal with the size of those wins. And so literally like a couple of weeks after we started dating, I bought a new Porsche 911, you know, I bought these other things. And so, I look back at that laugh because I would have probably thought the same thing too if I were her. Like, she's like, what are you doing? This you don't even go to work anywhere. You just sit in your barn living room and, place trades.
We all do the same thing now.
Yeah, exactly.
So, I had really thought about this, that what can I learn from you? I think one big thing which I really want to learn from you is, like, how can people sitting in India, can make money in microcaps in the US markets. But before that, even if I jump to my questions, I think you have made a presentation. Do you want to go through the process first, your presentation first, then I jump to my questions?
Sure. Yeah, that would be fine. I'm excited about creating a presentation. It's been a while since I did one on MicroCap, and so I put some slides together. I don't know if this will take 30 minutes, something like that. But I think it'll go over the opportunity set, and maybe not only just in North America, but even abroad for MicroCap, and also kind of tell you a little bit about how I invest in the ecosystem. And then at the end, if you have any questions, be happy to answer them.
So lovely. So you please help us with your slide with the presentation.
Sure.
Let us learn from you.
How does that look on your end?
Oh, it's very, very good. Okay.
Okay. Awesome. Okay, so I've entitled this presentation "The MicroCap Advantage." All great companies started as small companies. Maybe a little bit more about me. So I became a full-time private investor in 2008 into 2009. So that was kind of the trough in the economic crisis back then. And I became a full-time private investor. And then in 2011, I launched a website called MicroCapClub.com.
So it took you 10 years, almost 10 years, from reaching the level of that luck to skill, right?
Yes, I think that's a good way of putting it. And I can go back, after this presentation, or even some points during this where I can talk a little bit about how I evolved, through those years, and then even today.
I say that, Ian, because a lot of people or a lot of youngsters think that they can just come to the markets any point of time and make any number of money in a lot of stocks and do this or that. But I think it's a process, and the process can take, if a person like you takes 10 years, I think it takes minimum whatever number of years for someone to go from that cycle of, luck to skill.
Well, and for me, the decision, I had enough capital before 2008, 09 to become a private investor. Listen, I was single. I live in Lancaster, Pennsylvania, which, for those that don't know, it's a very rural community. The cost of living is very low, and so, I could live on a dime if I had to, but really I wanted to test my strategy through a bear market and see if I could survive it. And I didn't know that one was right around the corner with sort of the crisis of 08, 09. But, I was really waiting to be tested to see if my strategy could be trusted, through, a full economic cycle. And, what you hit on is very important too. A lot of people ask me how much capital you need to be a full-time investor. And, it's funny, you get this wide spectrum of answers, from people, that think they need a huge amount of capital. And then other people, especially the younger folks now that have only experienced, call it the last 7-8 years of a bull market, thinking they need very little because they feel, producing 30% returns per year is normal. And so, well, why wouldn't I produce 30? And when I have these conversations, and I said, a big part of me when I made that decision was, can I sustain 2 double-digit negative years in a row? Will that affect me financially? Will that affect me emotionally? To seeing my capital down, then drawing on that capital to pay bills. How is that going to? So I needed an amount that I know I could withstand 2 double-digit down years in a row, and it wouldn't change my strategy or my approach.
That's very, very important. Yeah, I think it's really big lesson for everyone that you should have stomach, to see those years if you want to be that kind of investor in the markets.
Yeah. So I ended up starting MicroCapClub.com, and it was really, I wanted to see what other smart people in MicroCap liked and why. And so started that in 2011. Today we have about 250 investors from around the world that are discussing, the microcaps they like and why. And it's mainly the United States, Canada. We're getting a lot more action in the UK and also Australia. So we don't have any any Indian microcaps on there, but I know you guys have Stock Picker and a couple other websites that I'm sure kind of are similar to what we're doing over here with
Okay,
MicroCap.
how can I apply for that MicroCap club? Because I love to be a member from India to be one of them.
Well,
Seriously.
yeah, no, you become a member by applying to get in and simply writing a 2 to 3 page investment thesis on your favorite microcap stock. And basically at the end of every month, our membership votes on the quality level of all the applicants. So on average, we probably have 20 applications a month that come in that then are voted on by our members. And I would say out of those 20, maybe 4 or 5 get in. And then we're also constantly pruning out those members that aren't active anymore.
Nice.
Yeah, and so it's free to get in if you have the merit, and so we have people that have probably $500 USD in their brokerage accounts, and we have some that have $1 billion. And so we have a wide spectrum, and we don't really say this person's better than the other person. As long as you show merit, and it's kind of one of the other things with microcap investing. Most great companies are first found by retail, the small investor, and so
true. So true.
Yeah, and so we want to allow those young investors that don't have much capital, that just have the fire in their stomach to go out there and research 25 hours a day. We want them on MicroCap, probably even more so than the person managing several $100 million.
Very true.
But so anyway, so that's MicroCapClub. Also, I just to mention, you're probably wondering in the lower part of your screen, IFCM. I now run some outside money alongside mine for some people that want the exposure to this ecosystem that I can provide them. So maybe first, just go over the disclaimer. Don't listen to anything I say or act on it. So I like to start off with this slide. And here in the United States, investing in small public companies, especially microcaps, is really not an accepted way to invest. The mainstream financial media over here likes to broad brush this entire ecosystem of microcaps or penny stocks as sort of a uninvestable wasteland of insignificant companies, to be honest with you. And this perception of microcap investing by financial professionals has always bugged me, because I love this space. It's where I cut my teeth. It's where I make my money. It's where I make my income. I know how important these companies are to the economy. And when people badmouth it, it's like somebody calling your kid an idiot, and so I kind of take offense to it. And I just like to keep the light shining, and that's why a big reason why I'm active on Twitter. And it's not for any personal ego reasons. It's really just to be a light out there for this ecosystem so it stays lit. And this negative perception is something I never quite understood, because at least here in the United States, everyone loves venture capital. Everyone loves private equity, which is basically investing in small private companies. And yet people hate the notion of investing in small public companies. And it really makes no sense when you think about that. People view microcap investing as risky, even though the failure rates are probably still better than venture capital, to be honest with you. The volumes in these small public companies are illiquid, but at least there's some liquidity to them, unlike in the private small company realm of private equity or venture capital. But on the left part of the screen, Warren Buffett, Peter Lynch, Joel Greenblatt, most of the best investors started investing and started in their careers investing in microcap companies. That's just a fact. Walmart, Amgen, Intuitive Surgical, Monster Energy, Netflix, even Berkshire Hathaway, all of these great businesses, some of the best performing stocks of all time were microcap companies. But even beyond investing, and maybe even more importantly, the 10,000 microcaps, which I'll get into in a little bit, combined employ as many people here in North America as Walmart does. So it's a very important chunk of our economy as well. And so I think it deserves our attention and respect, not only as investors, but also, just business people. So I guess the question here, and this might be the most important question or slide on this entire presentation, why microcap? I believe microcap investing is probably the only area in public and private markets where the small retail investor has an edge over institutions. You have the advantage. Probably most of the people listening to this presentation, you have the advantage over the institutions, not them. Most of these small microcap companies are too small and too illiquid for institutions to be able to buy them. Institutions can only buy them after their businesses mature, the stocks go up, liquidity increases. So the discovery of these companies starts with you, the retail investor. You're the smart money, and the institutions are the dumb money because they have to wait and buy them until they're higher. I think that's a pretty incredible structural advantage to microcap investing. The discovery of a small microcap company, normally happens in waves, and you can see it if you've been invested in a winner. It's first found by small retail investors, then it's found by large retail investors, then it's found by small institutions, then it's found by large institutions. That's sort of the discovery process of a microcap that turns into a larger cap. And unlike private equity and venture capital, where if, we're all being honest, you have to, in private equity, you have to work for the right firm to get the right deals. You have to know the right people. You had to go to the right Ivy League schools to get those, get Facebook at 100 million valuation. I mean, you're not going to be able to get them as a small retail investor unless you worked at Andreessen Horowitz or Benchmark or one of those big firms. But in microcap, however, you have access to everything. You aren't kept outside the gates to the city walls. In fact, in microcap, it's quite the opposite. The institutions are kept outside the gates of the city walls. They have to wait to invest in those things until after these stocks go up. So, so really that's kind of my pitch for microcap investing, is really the fact that you have the edge. If we're looking at the microcap ecosystem in North America, again, I'm combining United States and Canada. We have close to 20,000 stocks, about 19,500 to 20,000 stocks in North America. And most people defined microcap here in the United States as having market capitalizations less than 300 million. And by that definition, around half of all the public companies over here are microcap companies. Over here, investors, institutions, the financial media, they mainly only pay attention to the largest companies. So obviously the Apples, the Googles, the Facebooks, Microsofts, which I'm sure is similar to over, in India as well.
Yes,
Probably everybody's paying attention to the Nifty 50 index, or the ones that are in there. Right,
yes.
similar thing. So, these larger companies are larger businesses. They're, the kind of the upper end of this pyramid. The larger companies are larger businesses. They're more mature. And if you look at them as a whole, about 70% of those companies are profitable. Whereby the microcaps, they're generally smaller businesses or situations. And when you look at this group as a whole, these microcaps, around 15% of the microcaps are profitable. I think when we were talking before, you asked about maybe, what are the rules and regulations? Are there differences between a small and large company? And generally the rules of the smaller companies here in the United States are almost exactly the same as the larger ones. They still have to file with the Securities Exchange Commission, or at least most of them. And, they file their quarterly reports, which is called a 10Q over here. And that's the Q1, Q2, Q3 reporting. And then they file what's called a 10K, which is their annual report with the Securities and Exchange Commission.
What is the kind of liquidity you have in, say, microcaps in the US markets? Like we see the market depth for the large names, what we hear in media is huge. The size is huge. Now you say that the around 10,000 companies, which is one half of the listed companies, has a market cap less than $300 million. What is the kind of volumes which happen, like say average of 7 days or average monthly average?
It really depends. I'll go to the next slide once so you can see a little bit. I would say it really depends. There's a big difference, and I'm sure it's the same over there, between a 20 million market cap microcap and a 75 million market cap microcap and a 150 million market cap. The liquidity profiles of those companies can be very, very, different from each other. For instance, I'm invested in some companies now. Let's say one's a 30 million market cap, very small. That stock might have $10,000 USD of volume a day. but you can also find microcaps that are 50, 75 million market cap that trade $1 million USD per day. And so I would say there's no cookie cutter, approach to, well, this is normally what they trade. It really just comes down to how discovered they are, and also their size and liquidity. Usually around 100 million market cap here in the United States, you start to see the institutionalizing of that equity. That's when you see the institutions have the liquidity profile that allows them to buy into them. And so I'm mainly, actually just getting to the slide, I guess, looking at that sub 150 million market cap segment, because I want to find them before the institutions do. And as you can see on here, I mean, there's still, 8,000 plus companies here in North America that are sub 150 million. And, to be honest with you, I'm looking sub 75 million, because there's no research coverage. There's really very few institutions. They're very illiquid. They're also volatile, but that's also, what creates the inefficiency. And this is also where, you as an investor has an advantage. And, I think the other cool thing that's interesting about MicroCap, I get asked all the time, how do I find a great microcap? And, my response is normally, sort of, well, what type of investor are you? Are you a deep value investor? Because we have deep value microcaps. Are you a value investor? We have value microcaps. Are you a growth investor? We have growth microcaps. Are you a life science investor? Because we have life science microcaps. Are you in oil and gas? We got those. Are you, mining? Well, we have microcaps that are in mining. Almost every area and investment style in the larger equities, you can still find down in the smaller area, and which makes it unique. So, asking, how do I find a great microcap? My usual answer to that is, what type of investor are you? Because you'll be able to find something that probably scratches that itch that you have, or your area of competence, down here even in the smallest ones.
So yeah, I have a question here. So there's a rule of rejection, right? Say out of these 8,000 companies, if I have to, work with a rule of rejection in terms of whatever financial metrics I have to put in, whether, those are debt equities or the cash flow from operations or whatever you guys use at your end, what is the kind of investment universe as per you out of these 8,000 companies? Could that be 5%, 10%, 20%, because you have to eliminate based on certain financial metrics, right?
Yes, I have a whole slide dedicated to that.
Oh, lovely.
So
Sorry.
I'll wait to, but it's the right question.
No, I'm a smart person to ask you the right question early on.
Yeah, no, yeah, exactly. That's the right question. I have a whole slide dedicated to that. And so
Lovely.
we'll get there in a little bit. Actually, maybe the next slide we'll gear right into.
Lovely.
Sure. There we go. So, my strategy, really can be articulated, in this one slide. And I think this can be applied, almost any geographical market, not just the North American markets, which is mainly where I'm centered.
A lot of Indians will love this slide. I can tell you this, okay? Because we love this.
Yeah. So, I believe, the smaller the better, the more liquid the better, the least institutionally owned the better, the more misunderstood the better, the less known the better, operated by intelligent fanatics. And, I'll go a couple levels deeper into each one of these, here in some following slides. So let's go, so why the smallest? One of our MicroCap Club members actually did the research on this, which, I'm grateful that he did, but he looked at the CSRB database, which is basically all public companies in North America. You pull up all their historical returns and you can divide them up by, however you want to divide them up. But he looked at all the public equities since 1927, divide them up by decile, the smallest decile on the far left, the largest decile on the far right. And this takes us from 1927 to 2016, but you can see the smallest decile of the public markets has outperformed all other market cap classes, by a very wide margin. And that's, like I said, going back,
almost double, right?
Yeah.
Like 9% is the, return for the highest decile, and 17.5% was the lowest one.
Yeah, exactly. And, I think this is even more interesting. Roger Ibbotson, which is a Yale finance professor, he also runs Zebra Capital. He actually does this annually now. He updates this report, but he has a white paper entitled Liquidity as an Investment Style. And he went back historically in the United States since 1971 and looked at how liquidity was a factor in returns since 1971. And you can see the matrix on the screen here. In the upper left, you can see, microcap, low liquidity, and that return profile, compared to the other return profiles that are here. And you can see illiquid microcaps outperformed everything else since 1971. I think what's also interesting though is if you go to the high liquidity microcap area, so the upper right of this, you'll see that produced the worst returns. So illiquid microcaps, the best returns. Liquid microcaps, the worst returns since night. So that's an interesting dynamic, and it begs the question, why is that? And I think one of the reasons that is so low is something that I experienced actually in the 08-09 crisis, and that was usually when the liquid microcaps, which are the institutional microcaps, which are the larger half of the microcap ecosystem, they're owned predominantly by indices and by funds at that point in time. And when you're going through a market cycle and people are looking to take risk off because they feel like the market's going to get worse, the first place they go is taking off their risk exposure to microcap. And so you see this immediate sort of bid whacking in these larger microcaps. And I think they underperform greatly in bad markets because of that. And that's probably influenced this return profile for liquid microcaps since 71. But, I've never been afraid of liquidity myself. I always say kind of don't worry about illiquidity, worry about being right. Because if you're right on the investment thesis and management executes, the stocks go up. And it's one of those, it's kind of like the law of gravity, except almost in reverse. The higher a stock goes, the more liquid they become.
So how many companies you invest in a year? Honestly, like I understand your, your investment philosophy, but out of those 8,000 companies, which is almost 50% of the US markets, you guys will find how many? 8, 10, 20 companies in a year, because that's also important, right?
You keep jumping ahead, but I'll answer you. Now, usually,
I am so curious, okay, to learn from you. What can I do?
No, and I have a few slides devoted to that too, but that's okay. I mean, I can tell you quickly, and we can dive into it more later. But I'm fairly concentrated. I'm in about a dozen equities, so a dozen. And back when I was building my capital, to becoming a full-time investor, I was in 4 companies. So I was very concentrated, and I can get into that a little bit later on. But so yeah, I try to take that universe of 10,000. Well, actually, it's more than that because I have some investments in Australia now and some other areas, not just North America.
Got it.
But I'm fairly concentrated. So the next slide. All great companies started as small companies, and if you want to find whether it's 5 baggers or 10 baggers or 50 baggers or 100 baggers, it makes sense to look at the smaller end of the public market ecosystem, because obviously a small company has more room to run to the upside. And Connor Haley, who's a member of MicroCapClub, he runs a fund called Altafox Capital. He published a report middle of last year called The Makings of a Multibagger, and he studied about I believe 104 of the best performing stocks over the last 5 years. And I would encourage everyone listening to this to go and get that report. You can pull that down on altafoxcapital.com. Also, if you search YouTube for Altafox Capital and Multibagger and MicroCapClub, I did an interview with Connor, and I think everybody would really enjoy that. But kind of break down his 600-page report down to maybe a couple bullet points. The 30,000-foot view, when you study kind of great companies, the winners of the past, and also Connor's report, is that the 2 main drivers of returns are sustainable earnings and EBITDA growth and multiple expansion. And basically you want to find businesses that can grow earnings per share consistently over time. And on top of that, as a company grows, gets discovered, and more investors become bullish on sort of the long-term prospects of that company, the multiple expands. And so those are the 2 primary drivers of finding multi-baggers: are sustainable earnings growth and multiple expansion. And maybe for those that don't quite understand how powerful multiple expansion is, if a company doubles its earnings over 3 years, from say 10 million to 20 million, and the multiple stays the same, the stock doubles if the multiple stays the same. So you've made 100% return over 3 years.
Ian, here's a saying in India among our friend circle. It's like finding a good wife and a good girlfriend.
Yes.
Which is the earnest growth and the multiple expansion.
That's a good one. I
It's
like
the
that.
hardest thing. It's the hardest thing. Okay?
It is.
It's the hard. It's looks so simple, but it's the hardest thing. To have both of them together.
Well, and especially in this market that's getting overheated, it's hard to find something where a multiple can make sense to
You can't
expand.
have a wife and a girlfriend together.
Yeah, exactly. But that's honestly what that's what draws me to microcaps, is because that multiple expansion often comes from the discovering of a great company. And so if you want to discover great companies early, the small area, is the place to be. And that's why I focus on microcaps. Is it's one of the few areas, even in a market like this, that you can still find some companies that obviously have earnings growth and and can actually still expand their multiple, God forbid, because there's not too much more that things can expand on some of the larger caps right now, which I'm sure you would agree with. So next slide. So, what do I look for? And these are 4 general filters that I kind of put that list of 10,000 companies through. The first one is, I want to invest in a business that can grow through a recession. And that's one heck of a filter, and only a high quality growth company can grow, through a recession, if we're being honest. What are the, so you have to ask yourself, what businesses whose products or services are really needed? Which businesses produce products or services that are critical, unique, and differentiated? Those are the types of businesses I want to invest in. And quite honestly, this first filters out about 97% of the investable universe. And the second thing, it's pretty easy to understand, a balance sheet that can weather a storm and act with boldness. I love that Peter Lynch quote, where he said something like, "It's very hard to go bankrupt when you don't have any debt."
Yeah.
I love that quote. And I try to stay away from companies that have debt. In fact, I love to invest in companies that can take advantage of companies that get too levered. And that's what I want to find. I want to find a company that has a robust balance sheet that can take advantage of its competitors when they're weak, that maybe can acquire them or acquire some of their assets. So the third one, leadership team that shows signs of intelligent fanaticism. And I'll go through this a little bit deeper in one of the slides to follow. But obviously, you want to find great leaders. If you want to find great companies early, you got to find great leaders early. The fourth one here, evaluation that can conservatively double. I do, and this might sound odd in a market like we're in, especially here in the US and microcap, but valuation does matter. I don't want to be making bets based on the current environment continuing the way it is. I don't want to make bets based on a bull market and best case scenarios. I like to make bets based on worst case scenarios. I want to make an investment where even if I can be 80% wrong, I can still make money. Those are the type of bets that I want to be making. So really these 4 filters maybe filter down that 10,000 companies down to a list of less than 100 that are worth.
Exactly. So your universe goes down from 10,000 to 100 companies, right?
Yes. Yeah. And some of these, like I said, some of these 4 here, they're not just quantitative that you can just put into a screen and have the results pop out the bottom. Some of these are more qualitative. So, you have to really assess the business and management as well. But, and on the topic of management, so Charlie Munger was the first person to kind of use the term intelligent fanatic, and Professor Bakshi over there wrote about it, several years ago, and he kind of got me on the subject. And my a fellow MicroCapClub member, Sean Iddings, and I co-authored a couple books kind of diving into these intelligent fanatic principles, and really studying leaders that grew businesses from nothing into a business that dominated their niche or geography or area. How did they do that? How did they sustain that dominance over time? What were the characteristics of those companies, the cultures that they had? And we really spent a lot of time, a few years, kind of writing a couple books, diving into this more and more. And my main reason for doing so was to really kind of fine tune my qualitative lens for leadership and how to apply that to my investing in microcap companies, because if I want to find multi-baggers in the microcap realm, I need to evaluate the management to see if they have the people, the types of people that can scale that company, the culture that can scale, the processes that can scale, the systems and controls in place that can scale, and just systems in place where they can learn from their mistakes. And so a lot of that gets back to the people that are in charge, making sure that they have all those systems in place.
So how much?
And go ahead.
Sorry. So how much time do you spend honestly on the quantitative part? Which is screening, Excel. Is that like is like it's like 5%, 10%, and 89% is the qualitative part what you're mentioning.
No, I would say it's 50-50.
Okay.
I'm still usually first attracted to the business dynamics of the business first. And one of the things you find in small microcap companies, I know your definition of microcap in India is smaller than what I'm even talking about, and I get that, but so just think about the small ones over there. And same thing can be applied here. You run into a lot of microcap companies that are hustles. They're not businesses. It's a leader that it's him and maybe some other person that are running a business, and they're wearing every hat at the company, and they might even do a good job at it. I've seen some really good hustles in my day, being built up to 10, 20, $30 million a year turnover type companies that were mainly just a few guys, just doing a hustle, but it could never scale past them. And so you're trying to find real businesses that have the intelligent fanatic that wants to put great people around them that can really scale a business. And kind of one of the first things I look for or look at, and it's something everybody can do, is do they have a history of winning? Some of my biggest winners were betting on past winners, business leaders that had success, and then they came back into the limelight running a small public company, and they already won before, and they bring the team back together again, and they're going to do it again. And on top of that, they probably have the financial wherewithal, where they probably cashed out and have a big chunk of money in the bank account where they can fund their vision. They don't need to tap into the capital markets even to get them to believe in it. They have their own personal capital that they can invest to push their vision of the company. So that's something I like to see, and whether there's a history there, even if they don't have that, if there's still a history likely there with that company, whether it's 2 years or 10 years, and I like to look at their history of execution. What have they done since they've been on board? How do they talk about the business? Obviously, people love to say it, but I do like to see, skin in the game, alignment of interests. I love to see self-sacrifice, which is sort of, low salaries. I love to see when the CEO is kind of personally guaranteeing loans of the company. He's putting himself out there. I love to see that. I like to invest with management that have to live with the consequences of their decisions. That's what you want to see.
Nice. Got it.
And probably the area that I've grown the most throughout the Intelligent Fanatics project and researching them is actually, believe it or not, probably spending less time with the CEO themselves and more time studying the people they have around them. Do they hire great people? Do they give them autonomy to make decisions? Does when you are in a meeting with them, do they always have to be the one speaking, or do they sit back and let their second in command or their management level field questions, take control? That's what you want to see, because that's what a scalable business looks like. Ultimately that person has the last decision, but they let people lead and they put good people in those leadership spots. So that I spent a lot of time evaluating the folks around the CEO now, a lot more than I used to. I probably put too much emphasis on the CEO themselves 4 or 5 years ago, if I'm being honest with myself. And really, do they have a culture of excellence? Do they have a culture at all? So what does great culture even look like? Great culture is when you have customers that love the products and employees that love the company that they work for. A great culture, it's driven from the top down, but you can't really assess the culture of a company by talking to management. You tackle that by talking to customers to see if they're raving fans about the products, and you assess it by talking to employees when their bosses aren't in the room to
Yes,
see if they
yes.
love working there, if they would move across the road for another $1 an hour raise or something like that. Do they really love working there? I love, a big part of my process too is talking to ex-employees and ex-management level folks of the companies that I'm looking at. You know, because obviously if you're talking to somebody that used to work somewhere, you're usually getting a more negative slant on the company, or else they'd still be working there. So you have to take that into consideration when you interview those folks. But a lot of times, you know, they'll tell you how it was and the issues they had, and you know, you want to get a full picture of the business. So I talk to a lot of past employees and past managements, or not management, but C-level, you know, in the companies I
So
invest in as well.
you're not an investor, you're an investigator.
Yeah, no, it is. Like I often think that a journalistic type background where you're not afraid to pick up the phone, not afraid to interview, not afraid to dig is probably more important than being able to analyze financials in some regards.
Well, that encourages me a lot,
Yeah,
okay?
yeah. But yeah, I mean that. I think for me, you know, finding cultures, finding these great leaders, finding great people that work around the folks. You know, you can still find great businesses that turn into big businesses that, in fact, I mean, most large cap companies you look at least over here, because our ecosystem's a little bit, you know, the history is longer than over there where you are in India. You know, if you're looking at the largest companies in the world over here, most of them aren't founder led anymore because they're 100-year-old businesses. You know, whoever's running it probably owns like 0.1% of the company. You know, so you can't really expect them to, you know, pony up $20 billion to buy an interest into the company. You know, so there's obviously big successes where a CEO doesn't have skin in the game and might be
Yes.
have an above average salary, and they don't tick all these boxes I just recommended. But for the smaller end of the market, you know, I need to find leaders that align with my values, you know, because the key to investing is staying in your winners as long as you can. And because of that, you know, sort of these principles matter to me.
Nice, nice. You know, I was also told, honestly, by one of a great investor I admire in India, that you should know the factory manager more than the CEO. You know, so whenever you go and meet the management, it's fine, but you should always take the number of the factory manager, and because that's the guy who will actually tell you what's happening on the ground, not the CEO.
I agree with that 100%.
Yeah.
So, you know, I thought I'd just maybe go over some of my core investing principles, and some people looking at these, they probably look familiar because they've probably seen them in a tweet. But you know, these are really core investing principles of mine. And so, you know, we try to know, starting with number one, we try to know our positions better than most other market participants. And yeah, it's important because when you know your business is better than most, it allows you to kind of disconnect from the stock price, you know, but more important than knowing more, you know, more important than knowing these things so you can gain conviction, knowing more allows you to spot the signs of your investment thesis cracking quicker and before others. You know, and I'm still in this game not because of those big wins I had, which I had a few of them, but it's really because of the big losses I stayed away from. And so that's why you need to be on top of especially these smaller publicly traded companies, because they are small. They evolve in different ways. You know, I've said before, I kind of compare them to 3-year-old children. You know, you don't let your 3-year-old in the house alone because they'll burn your house down. You know, you got to watch them. You know, and so you got to watch your investments if you're in microcaps as well. You know, the second thing here, you know, we do the work so we can stand alone in our conviction. You know, our goal, as I said before, as investors, is to stay in our winners as long as possible. You know, and if you're talking about staying in your winners as long as possible, you know, that means you're going to have to go through that roller coaster, and you know, you're going to have to hold on when the stock doubles in 6 months. You're going to have to hold on when the stock pulls back 50% then from that high. You're going to have to hold as the stock goes, you know, nowhere for months or quarters, maybe even years, you know, as that fundamentals backfill into that higher stock price. You know, you have to hold as expectations get too high from the marketplace, maybe as your own expectations get too high. You know, you have to hold as the stock is cheap. You have to get hold as the stock's expensive. You have to hold on when all your friends are telling you you're an idiot for holding this thing. You know, and so you have to really be able to stand alone in your conviction to be able to go through that roller coaster of emotions and the stock price. The third one there, we're willing to look wrong in the short term to be right in the long term. I love that that Joel Greenblatt quote comes to mind, and it's something to the effect of, unless you buy a stock at the exact bottom, which is next to impossible, you will be down at some point after you make every investment you make, which is kind of interesting when you think about that. And it's so true. It's like, unless you down ticked or got the exact bottom on something, you're always going to be down in something. And, I find that to be, I don't know, it was a kind of I wish I would have thought of that and tweeted that before, but it's one of my favorite quotes from Joel. And, even though this makes a lot of sense as long-term investors, we all would prefer to be right quicker.
Yeah.
We all want to make,
Money every single
money
day.
quicker than anybody else. So,
Yeah.
we have to sort of have to balance this urge of immediate gratification with the reality that 95% of the time, you're going to look wrong before you're right. The next one, we invest in businesses that are undervalued that can get overvalued. I'm not a deep value investor. I have a lot of deep value investor friends, and I love them, and we exchange ideas all the time and thoughts on investing. I'm not looking to invest in businesses that can get less worse. I want to find special businesses where if they execute, a crowd of investors is going to be attracted to it. If I'm being honest, I want to find businesses that can get overvalued. Fairly valued isn't nearly good enough for me. I want to find businesses that can get overvalued, and great businesses will eventually trade at a premium because there's a scarcity of them. And I want to find those businesses early. We average up into positions when management proves themselves. Most of my mistakes in investing, and quite honestly, relationships too, was trusting someone too much right away. And conviction in an investment is a lot like love and trust in a relationship. It can only be earned over time. You need to see how that person really is and how they react in good times and in bad times before you can fully trust them. You're probably wondering, wow, are we talking about relationships or investing? But the same can be, I believe the same could be said for investing in stocks too, especially small ones. So I like to buy a position, a smaller one, and see how they execute, and then I'll buy more. Then I'm going to see and watch them execute a little bit more, and then I'll buy more.
Yeah.
And I'm a big fan of averaging up because that means I was right.
Yes.
There are people that execute.
Yes. The winners always average up, never down.
Exactly. And in the end, you want to own more of the companies that are executing and less of the companies that make excuses. So we let our winners become bigger portions of our portfolio because they've earned it. And some of my biggest mistakes were selling winners to buy more of my losers. And honestly, you should be doing the opposite of that. What's interesting is whether you own 10 positions or 50 positions, if you just let your winners run in your portfolio, you'll automatically become more concentrated. And more important than that, you're going to be more concentrated in your winners. And that's what you want. So stop overthinking that. You should be looking more at the company that's still down 50% for the last 3 years. You should be looking more at selling that one, not the one that's actually executing. You want a bulk of your portfolio in the companies that are executing. And, really, if we're being honest too, the ones that ascend, go up and become larger portions of your portfolio, they've earned the right to be larger portions of your portfolio. And that's kind of the way I think about it. The next one, we only add to losers if the business and growth prospects haven't deteriorated. And, I think put another way, I only like averaging down when it's because of macro reasons, like the entire market pulling back. I don't.
COVID could be the reason, right?
Yeah, I don't like averaging down because the company stopped executing. And so I think it's important to be self-aware enough of the current situation. Is this a micro reason for the stock pulling back, meaning the business, or is it a macro reason? The market has just pulled back. And if it's just the market, hey, I don't mind averaging down. But I don't like averaging down after a company stumbles and their valuation gets cut in half, betting that they're going to return to to where they were. You know, that I've lost a lot of money, you know, throwing good money after bad that way. You know, we want to hold our winners and work hard to identify our losers. You know,
Very
if we're,
important.
yeah, and if we're being honest with ourselves, you know, over your lifetime, you know, I hope I'll own a lot, but, you know, I think in general, even if you're really, really good at this game, over your lifetime, you might have 10 or 20 big losers, or I'm sorry, big winners. And then you'll probably also have hundreds of losers. You know, so what that tells you is identifying the losers in your portfolio is as important as holding winners, because those losers dilute your returns and kind of just waste your time. You know, successful stock picking isn't just about picking winners, it's about picking out those losers from your portfolio as
True.
well. You know, the end result of this, at least kind of getting back to MicroCap, because that's where we're centered. You know, MicroCaps, again, are these small emerging companies, and oftentimes they evolve in bad ways and they need to be sold. You know, over the last 2 years, I think my portfolio turnover over the last 24 months is about 100%. And I think people might be surprised by that. It doesn't mean I've sold every investment I was in. You know, I'm still holding quite a few companies I've been in for the last 2, 3, 4 years. You know, but what that does mean is there's been a lot of activity in the lower half of my portfolio. You know,
The
trying to
losers part.
spot, yeah, trying to kick out the losers, bring in some more rookies to the team, see how they evaluate or how they execute. If they don't execute, get rid of them again, bring in a new slate, and then holding on to those winners. You know, and it might be an unpopular comment, you know, for a buy and hold community, but, you know, oftentimes companies you own only deserve to be rented. You know, ownership is earned. And so, you know, what's my, I'm always get asked, like, what's my holding period? It's really as long as management executes. And that could be 3 months and that could be 30 years, but it's completely up to them.
Got it. No, these are very, very interesting and very important principles, you know, honestly. It's like having all the great companies in the world put together into one slide, right? You know, Apple, Amazon, Google, everything into one slide. If someone practices this, I think it's the best they can get from the equity markets.
Well, I think there's, especially in the lower end of the market, I think people probably spend too much time on buy and hold, buy and forget investing.
Yeah,
And people like to glorify that. And
exactly.
I think for a lot of people, it does make sense because they don't have the wherewithal to be a stock picker, and that's fine. You know, they can invest in the indices, and that's what they should be doing, just dollar cost averaging every month with their paycheck. You know, but if you're a stock picker, you know, there's going to be turnover, you know, to that portfolio. And, you know, I think, you know, 95% of what people talk about is, you know, the lower turnover, the better you are. That's not necessarily true. If you evaluated Peter Lynch, Buffett had turnover 100% a year, you know, 75% on average for like a 20-year period, which might surprise some people. And those were his best performing years. You know, and so portfolio turnover is the price of progress.
No, I totally agree with this principle. Yeah, and you know, we can have one another session on this. This topic. You know, high turnover, low turnover. You know,
Yep.
holding and sleeping and all. You know, I don't. You know, again, there are various thoughts to it, but I think you're right in what you said, because if you're a stock picker, you have to be very, very alert. You can't just sleep over it.
Mm-hmm.
You know. But
And so the last one.
I really like one major point in this principal slide is that, you know, you don't work too much on your winners. You have to work hard on identifying losers. I think a lot of our time, at least mine as well, goes on finding what is the next winner. But I think a lot of time has to go actually on finding the losers.
Yes. Yeah. I mean, that's 75% of my time is concentrated on the positions I already own, because what I don't own can't hurt me.
Lovely.
Yeah, the last one on here, you know, I believe slugging percentage is more important than batting average, and that's sort of a baseball kind of term here in the United States. But, you know, basically what I'm talking about there is power laws. You know, and it's even more pronounced in small stocks, and it's basically a fancy way of saying you'll have more losers, you know, but the winners will make up for those losers. you know, and so I don't intend to be right. I'm not going to be right all the time. My batting average, you know, is probably 50, 60%. So that means I'm going to be wrong 40% of the time. And getting back to our previous conversation, you know, that's why I spend a lot of time trying to find out which ones are going to disappoint me. You know, I actually love that George Soros quote, which I tweeted out the other day. It's something to the effect of, you know, it's not whether you're right or wrong, but how much money you make when you're right and how much money you lose when you're wrong.
Yes.
And that kind of hits, and that's like a whole book right there, just in a couple sentences, you know. So I thought maybe some folks would be interested in kind of my research process, in, you know, finding, analyzing, interacting, and research. So I call this, you know, I kind of made it up, but it's called you know, the FAIR research process. It stands for the FAIR: find, analyze, interact, and research. So the first one, find. You know, where do you start? You know, it can be overwhelming. Like we said, there's, you know, 20,000 public companies in North America. Half of them are microcaps. There's 75,000 public companies worldwide. About half of them are microcaps. You know, where do you even start? You know, and microcaps are small companies. They don't have analyst coverage. They aren't being spoon fed to you by Wall Street or Dalal Street machine. You know, you have to do the work yourself, you know, a lot of these cases. So here are a few to, you know, kind of to narrow down that universe. You know, obviously, if an investor is forced on US, Canadian, European, Australian microcaps, I would say MicroCapClub is obviously a great resource to find ideas. But to be honest with you, and I've, you know, started this site, it's one of many tools to find great ideas early, and it's one of the tools that I use. But I still use a variety of other ones, and a lot of these ones, you know, you can easily apply to your research process as well. And it's not rocket scientist, but the first way, quite honestly, is just brute force, and it's not sexy. But the only way you know you aren't missing something is to look at everything, and literally going through A through Z of public companies under a certain market cap, if that's what you want to look at, but literally A through Z. We recently did this in Australia, literally A through Z, looking over every single company. And it's very boring. It's very tedious, but you don't miss anything then. And that's the positive, that's the upside of brute force kind of research. And what I've found is oftentimes your edge is determined by your willingness to look through a mountain of uninvestable ideas to find the great ones. And there's no way about it. There's no sugarcoating it. It's hard work, but you know, a lot of times you know, if you want above average returns, you got to do what average people aren't doing. But so that's brute force. You know, networking is another one. Again, this is something everybody can do. You know, and this can take a variety of forms, but you know, microcap investors, at least the good ones, they're very independent thinkers a lot of times. And it can be lonely. You know, you think you're the only one doing what you do, and in reality, there are, you know, tons of microcap investors out there. But there's so few kind of physical, and maybe in light of COVID, or virtual areas to connect with other microcap investors. You know, but these venues do exist. You know, there's no reason to sit in your parents' basement reading financials and filings in some obscure public company wondering if anyone else is doing that. I can assure you they are. You know, there's people out there just researching constantly, and I think it's a huge advantage to go find them and, you know, just network with other investors. You know, the other one is just building relationships, and this kind of falls off of networking as well. But you know, I would encourage everyone to have a close group of investors to exchange ideas with, and not only people that think and invest like you, but people that think and invest differently than you. You know, you will learn more a lot of times by talking to somebody that is the opposite of you and successful as you will from investing with somebody, or talking to somebody that invests like you. You know, I have some friends that are deep value investors, and they've thrown up 38% CAGRs over the last 6 years. You know, how is that possible in a awful deep value environment? Like, what are they doing? Yeah, I can assure you I can learn something from them and apply it to what I'm doing. So find out and research and learn from other people that invest differently than you. I think you'll probably learn more than investing or networking and having relationships with people that invest exactly like you. Another area which I get asked a lot on is screening. And I think depending on your strategy in investing, screening can be more or less useful. You know, for example, if you're a deep value investor, I mean, obviously, I think it probably benefits you to do some screening and find things that are cheap, you know, based off financials. For me, I kind of look at screens as a trade-off. You can do like specific screens, and then it's a trade-off between specific and comprehensive. You know, I kind of view screens in two different ways. You have specific screens, such as, you know, I'm going to find stocks that have a 30% ROE, 30% revenue growth, that are trading less than 15 times earnings, that have insider ownership over 20% with little debt, insider buying in the last 12 months. And I guarantee you'll bring that 10,000 microcaps in North America down to about 25 companies, you know, if you just put a bunch of those screens on it. You know, but the problem is, everyone else will already know about those 25 companies because everyone else is already doing those screens.
True.
You know, so oftentimes with very specific screens, you know, you're sort of screening for the perfect setup. You know, but remember, a lot of times an opportunity is an opportunity because the conditions aren't perfect yet. And so I would rather, when I screen, do more of a comprehensive screen. You know, this would be like something like screen for all public companies under 100 million market cap, or screen all companies for insider buying in the last 30 days. You know, I do more of these comprehensive screens rather than really detailed, intricate screens. And I think the more detailed that screen becomes, the less effective it'll be. It's kind of the opposite of what you think, at least for me.
That's very, very interesting point, actually. To be honest, that's how everyone wants to invest, you know, and just taking some of the examples what you mentioned, just help us now, which is the screening website, if say I want to learn about some of the companies or the microcaps which are listed in US markets, which website will you recommend?
You know, there's lots of different screens you can use out there. You know, OTC Markets actually has a decent screen on it, otcmarkets.com. You know, a lot of different websites in the US now have screens. You know, I use Y-Charts, which is a paid service, but I think they even have an unpaid service that lets you screen for all of the microcaps in North America pretty easily. You know, there's a lot of different ways there's a lot of free screeners out there. There's also ones that you pay a little bit of money for that also provide some screening tools. But
is there any website which has the entire global microcap data? Like not only US, but Australia, China, Japan, everything, Europe and everything?
No. You know, in fact, your question is a maddening one, because I've been searching for a website that just simply has, and I'd pay a lot of money for it, that could just simply provide me with worldwide, you know, if I have 100 stock watch list across different geographies, US, Canada, UK, you know, India, Australia, you know, just something that gives me a chronological real-time feed of news and filings real time. Nobody has that. You know, I mean, you have to get a Bloomberg terminal, you know, which is 40,000 USD a year to have that. There's nothing below that price that you can get. I use probably 8 different websites to kind of get all that information from different websites, you know, from different websites. Like there's BAM SEC in the US is a good one I use. I think that's one of the best ones in the US for US equities. You know,
sorry, which one you said?
Then there's like SharePad in the UK, and like there's different websites like for different geographies that kind of do that area better than others. And I think it's probably because it's hard to get licensing deals with the governing bodies to get real-time filings. I think that's kind of the issue. I wish I had an answer for you. If somebody creates it, let me know.
Got it. I will. But you said for the US markets, I think you mentioned Y-Charts and OTC Markets. These are 2 websites which may help, you know, anyone who has to search for the data.
Yeah, and BAM SEC is another one that's really good. That's the one we use quite readily. It lets you do really good transcript searches as well. Like you can just do a search for, you know, name, you know, anything, and it'll, it's really good. Yeah. So where was I? Oh,
yeah.
I guess moving on to analyze in the fair. So the A in fair. You know, the first step, you know, that I like to do is to to watch out for red flags and fraud. You know, the best advice I can give new investors is to only focus on the profitable businesses. And as I said before, at least here in North America, 15% of the microcaps are profitable. And so I would just stick to that 15% because that'll alleviate 95% of your issues. But that said, you know, learning to spot, you know, red flags is crucial, you know, to getting the best return on time and analyzing new microcaps. And so, you know, just a few simple things that I do that I even find other people don't do is, you know, the first step, search Google for the company name, its subsidiaries, its management, its board members for fraud. Literally type into Google, Adam Smith, fraud. Center.
It's very, very important. You know, we
Yeah.
do the same thing, search for the management and put SEBI. SEBI is the regulator, like SEC,
Yeah.
right?
Well, and it sounds ridiculous how I just explained that, but I guarantee you there's institutions that don't even do that.
Yes.
You know, just a simple thing, just do that. So step one, you know, it's amazing how simple that is and how few do it. Step two, you know, look for, and I know this is prevalent in India, just like it is here in the US, but look out for those related party transactions. You know, is there some wheeling and dealing going on where the CEO is moving, you know, goods or services through another entity that he or she controls, skimming some off the top? You know, are there kickbacks, lease agreements tied to other private companies the CEO owns? You know, look out for all that stuff. You know, we have that quite a bit over here. You know, I'm sure you do too. So those are things you want to stay away from. I don't think I've ever seen a successful company that had related party transactions, you know, over the long term. Because that means they're trying to take more from the shareholders right out of the gate.
Yeah.
You know, but I also, you know, there's another area. It's not perfect, but you know, review the auditor. I know there's some auditing shenanigans in India as well, just over here in the U.S. So you know, people like to say that if you're in one of the big three auditors, that you're safe, and obviously that's not completely true. But I still like to see an auditor that has lots of clients. You know, I've literally looked at companies before where the auditor they use, they're their only client. You know, well, that might be a red flag. You know, that's, you know, so look at the quality level of the auditor. You know, I also look out for kind of promotional management teams that literally pay to promote, you know, their stock. You see that quite a bit over here in the US. You know, these aren't the types of individuals that you want to align yourselves with. And I'm not talking about paying for investor relations. That's kind of normal. But I'm talking about folks that pay large sums of money to distribute kind of marketing pieces through the mail or through the internet, you know, those types of things. You know, very few times that's going to be seen as reputable and result in a well-run business. I'll just put it that way. You know, so look out for those red flags. You know, next, and I'll kind of go over this quickly. It's the obvious things. It's probably one of the more important things, but obviously analyze the business and, you know, remember leadership matters, execution matters, culture matters, having raving fans as customers matters, balance sheet matters, valuation matters. And so without getting too deep into these things, you need to analyze, you know, all these things.
Yes.
So kind of switching over to interact, you know, interacting, if you remember from my opening story about how I got involved in this, you know, interacting is what drew me to MicroCap 20 years ago. The ability to sit across the table or over the phone with a management team of a company, even an idiot like me that didn't have that much money, you could still accomplish that. And, you know, that's still the thing that I love to do today. And, you know, since MicroCaps are small businesses, it's important to find out the types of people that are running them. You know, it can add significant value to your due diligence process.
Yes.
So when we're talking about interacting, you know, we're really talking about interviews and on the ground due diligence, you know, going beyond the numbers and talking to people inside and outside of that company. And this is going, you know, back to a lot of the things that I've hit on, whether it's brute force research or, you know, just like interacting, but 95% of your due diligence is analyzing if customers and employees are happy and why. You know, that's down to a sentence. And quite honestly, your edge is that 95% of investors will not do that.
I agree. I totally agree with this. You know, again, reiterating one of the points which I learned in my life was whenever you meet the management, never, you know, try to not go to a hotel with those guys to do a lunch or dinner. Always try to go to the home, you know, because then you get a chance to know, how they live, what kind of lifestyle they have, family values and everything. That gives you more perspective on the person, what the management is, rather you go out and just have lunch or dinner, in a hotel.
Yep, exactly. And so I think interacting can add significant value to due diligence. And what I've found is, quite honestly, many investors will say it provides no value, but oftentimes that's just an excuse because they aren't willing to put in the work. The last part of kind of the fair research process is research. And, I hit on this, I think, in some of our principles as well, but, many of you have maybe seen me tweet that we don't buy and forget, we buy and verify. And the smaller the company, the more often we verify our thesis. And, oftentimes it's your initial due diligence that you put in a lot of work and it allows you to pull the trigger on the investment. But the big money is made from this research, this maintenance due diligence that you're going to do, and companies change in good and bad ways. So the maintenance due diligence or this research is very, very important the smaller you go in the market cap spectrum. And so that's sort of the quick overview on sort of how I quickly research.
That's very, very important. It's very nice.
So I think I'll probably hit on a few things that you wanted to ask me earlier in the presentation on this slide, but I've always been a concentrated investor. In my 20s, I was in 3 or 4 stocks at a time. So
wow.
Yeah, I mean, but I concentrated heavily. I knew everything about them, and as my capital grew, now it's up to about a dozen companies, which I think most people would say is still really concentrated. But honestly, when I was investing in 3 or 4 companies, and if you would tell me, hey, Ian, in 20 years, the 40-year-old version of you is going to be invested in 12 companies, I would have said, no way. There's no way you can keep on top of 12 companies like I can keep on top of these 3 or 4. There's no way you could do it. But a lot of times, how you evolve as an investor, in good ways and bad ways, one of the things you learn is, what's important and what's not important, with the investment process and keeping track of the businesses you're in. And so, I probably put the same amount of work in as I did back then, in 3 or 4 companies as I do now with 12. It's just that I know what the important things are to look out for and to kind of stay on top of, and that's allowed me to scale.
But Ian, this is still very concentrated portfolio for a micro-cap investor, right? Say 12 companies out of a bunch of 100 companies you shortlisted out of the entire universe.
Yes, yeah, out of thousands, yeah, right.
Exactly.
No, I mean, it's still it's all I know. I've always been a concentrated investor. I probably always will be. My guess is probably another 5 years I'll be in 15 companies instead of 12. Because I get asked sometimes, even from my investors that are invested with me today, where are we going to be in 5 years? And I tell them we'll probably be bigger. What I mean by that is, I would hope that 3 or 4 out of the 12 that we own become small caps, $1 billion plus market caps. And we're not going to sell them just because they grew up to be a small cap and they're $1 billion market cap. We want to stick to a narrative that we're in small micro caps. No, that's stupid. So we're going to have some larger companies in this portfolio, and we're going to probably shave some of those profits off as they go up and redistribute that into some new rookies. So you'll have some rookies alongside some veterans. And so that bench will be a little bit deeper over time. So I would expect the portfolio to get a little bit more diversified, but it's I've always been this way, for better or for worse. So
So you start with say 20 and get down to 12, or is it like 12 only, but you keep on reshuffling?
Yeah, it's usually around 12 at all times. I think I've gotten as low as just in the last 2 years down to 10 and as high as 14. But it's normally around a dozen, at least right now.
How much time generally you give your ideas to prove themselves, right? Because as you said, buy and verify is your strategy, not buy and forget. So you must be giving some time to see whether, things are falling in place in terms of management, in terms of execution and everything.
I try to only invest. It's interesting. So to find a 10 bagger, oftentimes it looks like a company that loses 10 cents, loses 5 cents, breaks even, makes 5 cents, makes 10 cents. That's a 10 bagger. And whether that occurs over subsequent quarters or years, preferably quarters, that can re-rate really quickly and result in a 10 bag return. I'm normally trying to, listen, being too early is the same thing as being wrong. So I'm not trying to be a hero being out way too early. So I would say I'm normally giving a company a quarter, maybe 2-3 quarters in front of what I believe is an inflection. But it really depends on the situation. So, kind of when I started in my 20s, I was a story stock investor. I did not care about fundamentals. Just XM Satellite Radio is like a good example of that. I was mainly trying to find momentum before it happened. And I did fairly well at it because I did fairly well doing that. But then I evolved. So that was like probably 2000 up to 2005. And then I pivoted into investing in precious metals stocks from 2005 to kind of 2010 in 3 or 4 kind of emerging precious metals companies. And I did well because I got that tailwind of gold going from 400 up to 1900 in 5 years. That was the tailwind. So I hit that right, and we could go back and say that was luck or skill. I don't know, but so but each one of those, like that one, I dove in and really understood that industry. From there, only after I became a full-time investor did I really start looking seriously at financials. I think I read my first Buffett letter in 2008, like after I was a full-time, or early 2009 maybe. And it's not because I'm smart and probably dumb, but it's just my investment approach was so dissimilar to Buffett's that I just didn't see any value in it at that time. Now I value it. And so I really only started kind of putting, call it a fundamental drivers on top of my investing methods in 2009. And then I switched to a lot of GARP type situations. And then from there was a 2 or 3 year period where I got really heavy into healthcare, life science, medical technology type businesses. And when I look back now at my portfolio and these 3 areas that are up on the screen, it's really just a mixture of all that past experience combined into one portfolio, albeit a concentrated one. So I have what I call sort of the good to great business bucket, so those are the ones that, call it the compounders, which is an overused term, but, small companies dominate a niche, growing double digits, profitable, kind of ticks all those boxes. The next one is turnarounds. A lot of times these do look like value stocks when you find them. And usually what gets me interested is a new management team comes in, invests in it. Maybe there's a rights offering where the current management team ponies up a lot of cash to revitalize a company. Maybe they sell off an area of the business to raise capital to invest into a growth area. I mean, so, you can get 10, 20x returns by finding a value stock that turns into a growth stock. And so there's a portion of the portfolio that I would say kind of fits into this turnaround bucket. And then that last bucket there kind of goes back to my roots of story stocks. I call it like the rocket ship bucket, and in there, I'm looking for kind of venture capital returns, but without the venture capital losses. And so I'm not interested in zeros. I want to find businesses that kind of have an underlying asset or business where it has a lot of optionality, to where they have a bunch of blue sky type of initiatives where it only takes 1 out of 3 to hit, and hopefully you can 10x, and so I have a bucket of sort of those. So I kind of have the good to great, the turnarounds, and the rocket ships. Yeah. So that's kind of how I think about my portfolio today, and this could evolve. If we do this again another 3 years, this might change from here. I've changed and evolved quite a bit in the last 3 or 4 years, and I expect to change and evolve from this point forward as well.
But do you always meet the management before you invest?
I don't always meet them in person. I always talk to them over the phone. Like for instance, I can't fly and meet anybody right now, but I've made a couple new investments in the past 12 months.
No, do you always interact with the management before you invest?
Yes.
Okay. Got it.
Yeah.
So, okay, I have lots of questions to ask you. Okay, I'll wait for the closing slide.
Yeah, this will be quick. There's just ones that I thought about last night, but just closing thoughts for some people that are listening to this. And if you're new to investing or maybe even a little more experienced, just continue to be brave. Scared money doesn't make money.
Yeah.
You aren't going to be right all the time. You learn from your losers and draw strength from your winners. There's so many companies that I made a lot of money on in the past that I look back on and I cringe because I would never make that investment today. And part of that is just the complacency of youth or inexperience, but you also don't want to get, I think a lot of investors over time, their experience kind of funnels them into this narrow way of thinking where it's sort of like battered wife syndrome, where they're just scared to do anything that might cause them to lose money. And that's how you don't make money. You need to continue to take logical risks on things, and especially in microcap, because none of these situations, very few of them are perfect situations. A lot of them you're betting on something to change in a positive way. A lot of these have fur on them, if I want to call
Very
it.
nice.
Second thing, be vigilant. We talked about this earlier. Spend twice as much time knowing what you own versus new ideas, because what you don't own can't hurt you. Number 3, be humble. Investing, especially for a private investor, can be a very lonely game, even when you're winning. I mean, even when you're winning, you 10x on a stock and you're standing up, celebrating, jumping, and the only person there to congratulate you is your cat. It doesn't it doesn't have to be that way.
Yeah.
So congratulate others when they're winning, and help lift other people up when they're losing, because you're going to be there from time to time. Everybody is. And last but not least is just be you. What I found over the years is it's not how you're the same as other investors that proves your success. It's actually in the areas that you're different. So your strengths are oftentimes in the areas that you're different from other investors. So lean into that, lean into your giftedness. So that's all I have.
Honestly, very, very, there are so many thoughts which I learned from you. I have to see this again and again and again and again. But there are a few questions which are coming to my mind, and honestly, we have done the first thing is that it's not easy to be a microcap investor. What's the hardest thing you have learned being a microcap investor? Because all those things look very rosy on the screen, and I know it's not at all easy. But for you, with your experience of last so many years, what's the hardest thing?
I think the hardest thing still is how much rope to give a management team to perform to how you think they should be performing. And my rope has gotten shorter over the years, not longer. It's usually when I start rationalizing an investment is when I should be selling it. And I think that's still one of the hardest things. And I think one of the other things that I've learned over the years is, even 10 years ago, I was so about like, I want to discover this company. If I want to discover it, and I'm willing to bet ahead of maybe those inflection points in the business even starting to occur, because I think this is going to happen. And, just trying to get that first 100% of a move, when it's really a gamble and a speculation, not really an investment. And what I've learned over the years is, these are small companies. If they execute, they're going to go up 5, 10, 20, 50x. Like, I don't need to be taking the risk to be right on that first 100%. Why don't we just wait a little bit longer?
Nice.
Actually see it turn from a speculation into an investment, and then invest, because it's still going to have a long runway if they keep on executing over quarters and years.
Nice. What's the kind of risk management tools you use when you invest as a microcap investor? Because it's risky. The drawdowns could be 50%, 60%, or more than that. And I know that the drawdowns in even the large companies in the US has been to this magnitude. But as a microcap investor, when your portfolio is so concentrated, is there any risk management tools in your mind?
I think there's a couple different ways to answer that. I mean, I have my entire net worth in microcaps. So it's all I've ever done. It's all I've ever done. So this is what I do. And my risk, I don't see MicroCap as risky. It's just volatile. If you know what you're doing. And the way I go back and thinking about risk assessment is just going back to those 4 filters I explained before. Is if you find businesses that can grow through a recession, I mean, it doesn't get much better than that. You don't really have to worry that much. Yeah, their stocks will be volatile. When the market's down 30, they'll still be down 40, but they'll be the first to bounce back too. And so I just don't think too much about the macro. I just really stay centered on the micro, like what I own.
Got it. How do you decide to exit? When to exit?
Normally it can happen for a variety of reasons. The first and foremost is a company evolves in a way that is not good. So that's an easy one. The second one is you find something better than your 12th best idea in the portfolio. So that's another one. The third one, which I wish would happen more often, is a stock goes up too far too fast. And so you do have those occurrences. Something that goes up 10x in a year. It goes from trading at a 5 PE to 105 PE. And your experience tells you when a stock goes up this fast, there is going to be a 50% pullback, regardless, because it's just what happens. It's what happens with every big winner. They have big drawdowns like that, and so that's another reason why I would sell. And also if there's been a couple occasions of things I've owned in the last even 12 months where the company kind of told you for you. Even though the business was performing, all of a sudden you see insiders take 20% of their shares off the table. All of a sudden they put, at least here in the US, it's called an ATM. It's a way to raise capital. You basically can sell shares into the market. So all of a sudden you see them raise $10 million in an ATM where they're literally just selling stock into the open market. Well, that's kind of telling you it's overvalued, don't you think? And so I've had a couple of them where it was kind of painfully obvious, if you just looked at how management was acting, that it's probably a good time to take some off the table as well. So there's probably 4 or 5 different reasons why I would sell.
What's your biggest mistake? And more importantly, what's the lesson you learned out of it?
My biggest mistake in investing was investing in a company that ultimately ended up being a fraud. And this was right after I became a full-time investor. I had 30% of my portfolio in it. And I woke up one morning and the stock was halted. The auditor couldn't find the supposed cash that was on the balance sheet.
Oh.
And when it reopened the following day, it opened 45% down. And I sold every single share I had as quickly as I could. And 2 months later, that stock was 0. And I've always viewed that as I felt lucky to get out at a 45% loss in that position based on what ultimately occurred there. And I had no idea when I sold it if it was, an outright fraud or not. But I just knew this was not. It was going to be years before anybody would trust this company again. So I just exited. But I don't know. And they had a decent sized auditor auditing their books too. I think the learning lesson that I took from that was the product and service itself was not one that I really understood. I was drawn to the company because of the financials of the company, not necessarily because I really bought into the product or service that they were selling at that time. And something that even bugged me as I was investing in it. But it was great. It was growing 30%, had a great balance sheet, and trading at 12 times earnings. Like, who cares? Just buy it. And so my lesson now is I really only invest in situations that get me excited about what they're doing, their product or service, that I can really almost holistically buy into, because it's the only way that I'm going to be able to hold that through that roller coaster of emotions and stock price. And that's even how I've evolved in the last 2 years, where even 2 years ago, I was still owning them, not because I really loved their product, but because I liked their financials. And the problem is when you only like something for their financials, you're always just investing for the next quarter, for the next set of numbers. And any time that they would ever stub their toe or anything like that, I know I'd be out because I didn't really buy into what they were doing in the first place. And so it's just a waste of time for me.
Very nice point. Very, very nice point. It happens all the time. It happens all the time with everyone.
Mm-hmm. Yeah. So that's probably the biggest thing. Like and I tweeted this out, I think earlier in the year, and I put it in my letter to my investors. It's like, if if you're not excited about the future, you're in the wrong investments. And that's how it's my overarching lens in my portfolio.
So when you start looking for some of these microcaps, which you have to invest, the screeners are not your starting point, right? It may be your circle, the MicroCapClub, the intelligent people around you, the products, everything like that, right? And
It's everything.
Then comes the financials later, right? If you get excited by that.
Yeah, I mean, I have tentacles out everywhere trying to source ideas. Some of my best ideas came from unsavory characters.
So Varinder Bansal from India.
Yeah. Well, I mean, you probably see this. You probably believe, I kind of still view MicroCap as like you're living on the streets. It's like I get some of my best ideas from what other people would call unsavory characters, if you want to put it that, but they have their ear on the street and they hear what's going on. And, I'm constantly having tentacles out trying to get a first look at something that could be great. And so I have no biases taking ideas from anybody.
Which are the emotions you control, Jan, when you invest in microcaps? Is there a need for that? Like, what can anyone who is watching this learn from you? Is it like I have to be technically very sound running computers? I have to be technically very sound in terms of screening a lot? Or what are those nuggets or what are those things in you, what makes you Jan?
I just think you have to have a real curiosity for investing. And I think we all have areas that interest us. I was talking to an entrepreneur the other day, and he runs a software company, and he's saying, where should I look? And I'm like, well, you run a software company. Maybe you want to look at software companies, that are microcaps, because you have an expertise there. And so if you have an expertise anywhere, I mean, that's the first and foremost place to start. Another thing to start is, you need to understand the language of business, which is accounting. You need that, and so if you don't understand accounting, how to read an income statement, balance sheet, cash flow statement, all of those things, you can pick up some good books that you can get you a pretty good primer in probably a few weeks to a month. But I just think really it's just about the curiosity of it. And, I have all my net worth in microcaps. For most people, that does not make sense. When I talk to other investors about it, in fact, I do the opposite. I said, you should not have more than 10% of your money in microcaps because this is volatile.
How many hours you study in a day?
What's that?
How many hours do you study in a day, for the quantitative, qualitative, everything in terms of curiosity?
It really depends. My day, I don't know if you're familiar with interval training and fitness, but
no.
It's if you were exercising, interval training is if you go out and do some sprints for 5 minutes and then take a minute off and then sprint again for 5 minutes and then take a minute off. You bring your heart rate way up and then you bring it down. You let your heart rate just get back to its normal rhythm, and then you just pick it right back up again. And some of the best long distance runners, marathon runners, many of them, obviously they train by running long distances, but a lot of it's equal amount of interval training, which surprises people because that's how they get their lung capacity up, is through that interval training. And I find it's the same with how I learn as well. And so my days are pretty unstructured, but it's 20 minutes usually of intense learning or reading, followed by 5 minutes of doing nothing or doing something else, coming back, doing another 20 minutes or 30 minutes of something, take another 5 or 20 minutes, go yell at the kids, come back in, 20 or 30 minutes. It's a lot of this, rev up and then right back down. So
a good analogy, by the way, but I also have a small rapid fire round for you, if you don't mind, and let's
Sure.
take it very quick. Okay. Did you throw the garbage actually, which your wife asked in the morning?
That's tomorrow morning. So I'll be doing that tomorrow morning.
So if you were not a microcap investor, what is that another thing what you wanted to be in your life,
I'd probably be unemployed. I'm not even sure, because I really have no other skill set than this in my life. My wife makes fun of me all the time. Like, I can barely change a light bulb. So, so I don't know what to tell you. If I wasn't doing MicroCap, I'd probably be investing in small private companies or something, because I have no other skill set.
So if given a chance to ask one question to Mr. Trump, what would you ask?
I'd probably ask him if there's anything he wouldn't do or say to get votes. That sounds harsh, but
That's true.
That's probably the same question I'd ask any politician.
Okay, given a chance to ask one question to Mr. Modi.
What's that?
Given a chance to ask one question to Mr. Modi.
I'd put that back on you. What would you ask?
Let everyone invest in India. Let everyone, just welcome everyone in India. That's if I have to ask one question, I'll do that.
Yeah. No, I mean, I think that would be a great question to ask.
Yeah. Any ex-girlfriends you have in India?
Well, that's why my wife won't let me come visit.
Which is your best quote? What you have been inspired, and please say that in Hindi for us, okay?
Yeah, I don't know if I can say it in Hindi, but
you can try. Okay, I'm sure.
See, I think my favorite quote is the one from J.P. Morgan, which is "Go as far as you can see, and when you get there, you'll be able to see further."
Okay.
And I think that's good advice for life. It's good advice for
that's
investing.
Nice.
Yeah.
So
I think that's my favorite one.
So can you convert the same in Hindi for us, or any other? Okay. and let me teach you. Okay, let me tell you one sentence which, if you want to say in Hindi, you can say "Maza aa gaya aaj."
Okay.
Maza
aa
gaya
aaj.
Omkara. So it means that we had a fun day today. Okay, thank you.
We certainly did.
It was really nice, and thank you so much. I honestly have to see this again and again, because it just refreshes so simple things, but so important things in terms of investment style.
Yeah, no, I'm honored that you had me on, and like I said, this is something that I've been wanting to do anyway, and you reached out at the perfect time too, because I've been wanting to do something in India as well, because I've met so many great people over in India, and because of COVID and whatever, I don't know when next time or when I'll be able to come over there in person, but it's definitely on the agenda once the world opens back up again. So I appreciate it.
We are honored, Ian. Honestly, I am honored. I'm sure that India and everyone will love to learn from you. I look forward to be more and more in association with you. But thank you so much for taking time out. And please, best wishes to you and your family.
Thank you.
Thank you.